Jenny Brown. Welcome to this week's MFB News. I hope everybody is fine and dandy and keeping really well. So welcome to the new home of MFB News, my office, which we moved into this house last week, and this was the first room that we've decorated, obviously most importantly because it's mine. The walls were purple, they're now obviously white. We've done some lifting of carpets, stripping floors and so on. So one room down, and we now have the rest of the house to do. We have made good inroads with the unpacking. We're only down to the last few boxes now. All I can say is, my God, isn't moving house exhausting? I've forgotten how much work goes into it. Those first few weeks are really full on, but we're very happy here. And I know a few of you have messaged me saying congratulations and sending good wishes. So thank you so much for that. I really appreciate it. Now look, what we've got for you this week, some really great content for you. We've got the usual lender updates. There's been some interesting changes, including one lender who's actually pulled away from lending. They've stepped out of the market. So we'll talk a bit more about why that has happened and what that means in terms of the broader market and whether we can expect more of the same. And then what I'm going to do is just chat to you a bit more about the Leasehold Reform Bill and what's been happening there as well, and just bring you up to speed with the latest news on that. Okay, so first up this week from the lenders, Kent Reliance have made some pretty chunky rate reductions across their range of up to 70 basis points. Now, Kent Reliance as a lender, we actually really rate them very highly. They're not the cheapest buy-to-let lender on the market by any stretch of the imagination. But what they do is have some fairly niche pieces of lending policy. So by this, what I mean is, first of all, they can lend to individuals and limited companies. They're very happy to accept layered limited companies, so a company owned by a company owned by people, but what they will not accept is trading companies. Now what they do is they're taking their personal guarantees with limited company lending from the directors only, which therefore really facilitates those companies where there's a slightly more complex shareholder structure. So for example, if we had a limited company where mum and dad were the directors and mum, dad and two children were all 25% shareholders, that kind of arrangement wouldn't necessarily work with a lot of the other lenders, whereas because Kent Reliance are only underwriting and taking personal guarantees from the directors, that can work. The other thing that I really like about Kent Reliance is they don't have as such a maximum exposure to a borrower. What this means is they don't cap how much they'll lend to any one borrowing entity, whether it's a person or a company. So I was chatting to one of the guys from there yesterday, and I was saying, oh, one of my clients has got a really large portfolio. You know, how much can you potentially lend? And they said, look, we've got clients who we have lent over £30 million to. We've got £30 million ongoing. You know, so actually we can look at large loans. So that's really fantastic. What they do is, generally speaking, they'll give someone up to £3 million. After £3 million, then what happens is the client is presented to the credit committee, and there's a small interview as well with the borrower. Now, the reason this is really interesting for some people is that what will happen is at this point, the credit committee will agree to lend the borrower X amount of money over and above the £3 million. So those borrowers who either have some fairly ambitious purchase plans for the year, or maybe they have a lot of remortgages to do, what you can do is get the facility pre-agreed up front. They tend to sort of do it in chunks of £5 million. Which is, you know, enough to keep most people out of trouble for at least a small period of time. But it means that actually you have kind of a guaranteed mortgage line, you know, ready for you, subject to valuation, which some people really appreciate. So the pricing now starts from 2.49%. They can go up to 80% loan to value. They've also done the same thing that Paragon have done. They've now blended their products. They're not differentiating on price between standard properties, HMOs and multi-units, which they also do incidentally. And like I say, they don't have a maximum number of properties in the background. Now, the other thing that I really like about the Kent Reliance approach is that when they're underwriting the cases, the underwriters there are quite experienced, and they do actually, as individual people, review the cases and are able to make some commercial decisions if there is a small credit blip in the background, that kind of thing. So as an example for you, we have had clients who missed a mortgage payment, say 18 months ago. They didn't miss the payment because they didn't have the money to pay. They just hadn't transferred funds from one account to another, and so, you know, unfortunately a missed payment was registered. That would rule them out with most lenders. Whereas with Kent Reliance, because we could show actually it was just an administrative error on their part, they were able to lend. So really good. They've brought their pricing down, and they're also retaining their same great lending criteria as well. BM Solutions have changed their rental calculation, which they use for people who are remortgaging on a like-for-like basis. So what that means is if you're going to them, you have an existing mortgage of £100,000 and you're still borrowing £100,000, so you're not raising any capital. they will give you now a more favourable stress test than they would do if you were either A, purchasing the property, or B, refinancing it for an extra amount of borrowing. Okay, now look, in terms of what this means for people and where this sits in the market. So look, stress tests are really complicated insofar as every lender has a very different approach for this in terms of the calculations they're using. But not only is it different from lender to lender, it will differ between different products. So as we probably know, 5-year fixed rates will carry a more favourable rental calculation than 2 or 3 year rates, or indeed variable rates. Likewise, some lenders will apply different stress tests depending on your tax code. So if you're a basic rate taxpayer, you would obtain a more favourable rental calculation than if you're a high rate taxpayer. And also some lenders apportion different rental calculations depending on the kind of property that they're lending on. So some would expect a HMO or a multi-unit to yield more strongly than a standard single property. So they would impose a higher rental calculation on these. So the fallout of all of this is that actually how much you can borrow per pound of rental income is quite complicated. Well, not complicated, but actually there's just lots of kind of different permutations to this. If you are in the market for a mortgage and want to see how much you can borrow based on the rental income, there's 2 things you can really do. First of all, you can obviously give us a call, but the second option is that on our website there's a rental calculator, so how much can I borrow facility online, which is really, really useful, just because it's so complicated. Now, in terms of what BM Solutions have done, it's really fantastic. They're obviously looking at their proposition, sort of ascertaining where it sits in the market and making amendments, and bring themselves in line with some of their competitors as well. Is this earth-shatteringly amazing news and very unique? Definitely not, but what they are doing is aligning themselves with some of their competitors. Okay, in terms of some pricing movements on the market, we have seen the Leeds Building Society pull a bunch of their 5-year fixed rates at 60% loan to value. They've reintroduced them at a higher interest rate. The Nottingham Building Society have reduced their limited company rates by up to 19 basis points. The Coventry have also made some adjustments to a few of their products downwards by up to 14 basis points as well. Now, Habito have reduced some of their rates and also removed some of the products with fixed fees. In the round, the offering is still pretty good in terms of very, where I'd say they sit in the market, very, very clean limited company transactions is really, I think, where Habito excel. Now, we've also seen the Finesse add products and reduce rates. So they've added some 80% loan to value buy-to-let products, which are green products only. So those are the products for properties with an EPC rating of C or above. They've also introduced a couple of lower loan to value products, which now start from 2.89%. They've also made some reductions on their holiday let offering as well. These have come down by up to 30 basis points. We've also seen Paragon add a couple of new remortgage only products. I mean, look, Paragon, to my mind, their pricing in terms of the kinds of properties they lend on is just incredible. So they have pricing now starting from 2.77%, and these are available on standard properties, multi-units and also HMOs. And their HMOs can be up to 20 beds and their multi-units up to 20 self-contained units. So they can lend on really quite lumpy properties. Traditionally, anything over roughly 8 units, 8 bedrooms would have always, in times gone by, to more commercial lenders where you'd be paying commercial terms, the loan would need to be amortising, that kind of stuff. But actually, up to 20 units, would cover off a large number of, the types of blocks of flats that we certainly come across as a business. So if you think about it, getting a rate of 2.77% is just incredible. So great to see Paragon bringing out some really good products there as well. Now, in the last day or so, we've seen Masthaven stop lending in the market. Masthaven was founded as a non-bank lender in 2004 and acquired its banking licence in 2016, but it's made its announcement that it's withdrawing from the market to employees, customers, intermediaries and other stakeholders. So basically it's shutting up shop. Now, in terms of where this lands, if you are a Masthaven borrower, do not worry. Your loan will continue. There's no changes there. You're not going to be suddenly expected to pay the money back or anything like that. The loans will simply be sold on to a third-party institution. And this kind of thing actually happens all the time. It's very normal to take a mortgage out with one institution and then sell the loan on to somebody else. So realistically, if you are a Masthaven borrower, you shouldn't really feel the impacts of this, other than the fact that the name of the lender who you're with will ultimately change. Now, if you are someone who has invested with Masthaven, don't worry, they're committing to returning all of the savings deposits to its customers. They've got enough capital and liquidity to be able to do this as well, so please don't worry. Now, in terms of why this is happening, now Masthaven haven't kind of announced exactly the reasons. There is definitely a school of thought at the moment where the pricing has been so competitive and the cost of funds has gone up. So lenders' cost of funds have increased, but the amount of money they're charging borrowers on their interest rates is sort of stayed largely the same, maybe come down a bit or moved up slightly, but it hasn't kept up with the cost of funds on the wholesale markets. Actually, the commercials just aren't working out for some lenders anymore. They don't see lending as an attractive proposition and they just close down. We saw this at the start of COVID with a couple of lenders as well. So what does this mean for the broader market? So look, at the moment, when we heard the news about Masthaven, we put in some phone calls to some of our lending partners. They were very sad to hear of Masthaven's news, but actually they're very robust in their approach. What they're saying is that, look, actually, you know what, we're very committed to continue lending. We've got no plans to move away from the market, but the reality is that we can't keep on with these very low rates forever. We're going to have to start putting our rates up very, very soon. So I suppose really what we can take away from Masthaven closing down is that it's a bit of a warning shot across the bows in terms of where lenders' pricing is going to have to go if they are to continue to see lending in the buy-to-let space as a viable commercial proposition. Now, depending on when you're watching this, you may or may not already have the answer to this. So I'm recording this very early on Wednesday morning. Tomorrow the Bank of England meet and will be announcing whether they are increasing the base rate. The expectation is that it will increase tomorrow by 0.5%, and there's also an expectation that there will be a further 2 increases throughout 2022. Now, in terms of what this means for you, so look, if you're on a fixed rate, there's no immediate change to your arrangements. Your fixed rate locks in an interest rate for a period of time. So for now, there's nothing to really worry about. If you're on a variable rate or a base rate tracker, your payments will invariably go up, unfortunately. Now, look, in terms of the conversations we're having with lenders, in terms of their pricing, and also with our clients, you know, the reality is that at the moment we are facing a pretty much guaranteed period of interest rate increases. With inflation being so high, the Bank of England really have not much choice other than to push interest rates up as one of the measures that they will implement to try and slow inflation down. So really the message here is very clear. If you have a mortgage, a remortgage coming up in the next 7 months, please do investigate how you can lock into rates at today's pricing rather than waiting until 6 months' time when interest rates will have gone up. We can help you with this. We're doing lots of this at the moment. It's slightly more tricky if you're looking to buy a property. The process of applying for a mortgage is such that you can't actually apply for a mortgage. You can get an agreement in principle, but you can't actually make a full application where you lock in the interest rate until you have a property to buy. So actually, until you found a property to buy, you can't secure the interest rate. And what I would absolutely not advocate is you rushing out to buy a property in the next week just so you can secure a low interest rate. That's not really the way to do things. But look, you know, remortgaging definitely is one area where you can get in there and secure the rates before they go up. Okay, now there's been some movement on the Leasehold reform bill, which has been kind of in the mix for quite some time now. So multiple organisations have signed up to send an open letter to Michael Gove, urging him to implement the already announced leasehold reform measures as soon as possible. So in the letter, the companies were saying they were pleased to be working with and supporting the government's leasehold reform plans, and who'd work with the government to develop policies that would lead to real-world improvements. However, the letter also said that it was disappointed that the government had not implemented these measures, and call on the government to include already announced measures in future legislative plans as soon as possible. So look, earlier in the week, the Leasehold Reform Bill passed its 3rd reading in the House of Commons, bringing it one step closer to becoming law, but key amendments around the removal of ground rents for existing properties were defeated. So key leasehold reform measures, the letter aims to drive onward and include the following. So the removal of the ability to convert an assured shelter tenancy for ground rent of over £250 per year or £1,000 per year inside London on long leases. It also called for the implementation of reasonable fees and timescales for administrative activities, freehold owners to have the same rights as leasehold owners, and the removal of estate rent charge owners' rights to create a long lease where rent charges are unpaid. It also continued that it wants recommendations from the Law Commission's 2020 report to be executed, which suggested reform on leasehold enfranchisement, right to manage and common hold as well. So there's lots of going on here. The general consensus amongst landlords is that the leasehold reform bill would be a real positive, mainly because there's so many landlords who are letting or own properties which are leaseholds, and some of the sort of more historic rules and rights that sit around the leasehold agreements are very punitive. We've also had issues where some properties, the ground rent and service charges, they increase at a certain rate where the deal becomes unattractive to lenders and actually the property becomes unmortgageable as well. So these reform bills will essentially put to bed the ability to ramp up these costs to a level where the properties stop being seen as good security for lenders. So look, this is still carrying on in the mix. It sounds like there's increasing pressure on the government to get their act together and get this sorted now. Obviously, there's things going through the Commons at the moment which are being threshed out, so we are on a good trajectory with this. And of course, we will keep you posted with more news as it follows. And that's me for this week. Thank you as always for joining us. I hope you found that helpful. If you have any questions on any of the content that we've covered off today, or indeed anything mortgage related, and just to remind you that we not only do buy-to-let mortgages at Mortgages for Business, we do homeowner mortgages, commercial investment, commercial owner occupier, development finance and bridging finance as well. So all of those things, if you've got any questions, we'd love to hear from you. 0345 345 6788, or go and have a nosy around on our website. There is lots and lots of information to be found there. Have a great week, have a great weekend, and I'll see you again next time.